welcome back to the 1% Playbook. We're going to dive into lesson 2 today on what is price action, how we can read these charts naturally without using indicators so that we know what these candlesticks are doing, where they open at, where they close at, and how we can identify certain patterns in the market, okay? So let's jump right in here. Most of everything you're going to need to know, we're going to go over candlesticks. I'm going to go over market structure. We're going to go over support and resistance. We're going to go over patterns. So support and resistance is, well, basically the same thing as area of interest, which is the terminology that I am more familiar with. But support and resistance, area of interest, supply and demand zones, they're all the same thing. We're going to go over candlesticks, market structure, support and resistance, area of interest, and patterns. So to start off with candlesticks, we're going to be looking at the open and close of a bullish candlestick and the open and close of a bearish candlestick. So I went and found a little chart here on ICICI Direct. But they've got a good chart here that kind of shows what the bullish candle is, the bearish candle is. So you've got your high price, which is the tip of the wick. You've got your close price, you've got your open price, and you got your low price. So when the previous candlestick closed and the new candlestick began, it opened up right here, probably came down here to the low price, came all the way up here, and then ended and closed right here. So price is here at your close price. And then let's say the next candle was a bearish candle and it opened right here where this one left off, where the bullish candlestick closed. Your bearish candlestick opened and then closed down here, came down here, wicked up. So if I guess what happened here was your bearish candlestick opened here, came up, came all the way down here, and then closed right here. So if you want to, you can screenshot this so that you guys know what the candlesticks look like and how to interpret the candlestick. So I'm going to put right down here, bullish candlesticks mean buyers are in control, and bearish candlesticks mean that sellers are in control. So we had a lot of buy here. Here's an example of a bunch of bullish candlesticks. So we had, let me zoom in here. So we had our open, our close, open, close, open, close, open, close, open, close, open, close. Had a little doji here, but had a, yep, that's your little open, your little close. Then you had your open up top now, your close, your open, your close, open, close, open, close, open, close, open, close. Got a little doji here. So does that make sense? So all reading a candlestick is you've got your open, your close of the body candlestick, of the body of the candlestick, and then you've got your wicks where price went but did not stay. And wicks are important because they show us where price is rejecting. So as you can see, had this big wick or liquidity grab, probably took out a lot of people. And as you can see, it was rejecting this area up here, which then caused the market to go down. Then sellers took over the market and are taking over the market currently. Probably come down into here, might have a little pullback, and then continuation to the downside. But those are your candlesticks. So I do want to tell you guys that the bodies of the candlesticks, whenever the body closes, that is the candlestick's strength. That's where price is. These wicks are rejections. When a body candlestick closes, for example, if we're wanting to enter a trade and we are going to wait for a 1 hour engulfing to close. We're not going to get in because it could just simply be a rejection. We want confirmation. So jumping in here to market structure. So okay, so this is super, super important. Market structure is how you are going to be able to identify the trend of the market. If the market is going up or if the market's going down. Okay, so we want to identify the trend on our top 3 time frames. That is the weekly, that is the daily, and that is the 4 hour. Okay, so let's over here, market structure. What is the trend of the weekly, daily, and 4 hour time frames? You can identify the trend one of two ways, either bullish or bearish, right? So we're going to start in the weekly. So a lot of traders get this wrong. They don't know how to read market structure. And if you don't know how to read market structure, you can't completely identify the trend of the market. Therefore, you don't know if you're trading with the trend or not. We want to trade with the trend because the trend is your friend. So, trade with the trend, make money. Now, what market structure consists of are higher highs, higher lows, lower highs, and lower lows. Okay? So bullish means higher high, higher low. Bearish means lower high, lower low. We'll kind of go over this here. So here on the weekly, I have already, I can look at it right now and I can just tell that it's bearish overall. Even though it might look like it's going up, it's actually still bearish and we would be selling. We would be selling the market or we would be shorting the market. Let me explain why. So I've drawn some lines here just showing what our lower high is and what our lower low is. And if you can master market structure, you are ahead of 90% of traders. This is going to change the game. You're going to know exactly where the trend is and where you want to be buying or selling. So that that's the big question is, okay, are we buying or selling this market? If you can find out the trend of the market, then you can find out, okay, we're either buying or we're selling. So right here we have a what is called a lower high and a lower low. So we shifted below this previous structure point, now shifting the market bearish. So now we would be looking for sells. Okay, so let's keep going here. So we have a lower high, our lower low, kind of came up a little bit here, broke below this lower low, now shifting the market even more bearish, creating a new lower low and a new lower high. So the market is still bearish. Now we came back up, broke below this lower low. When it breaks below a lower low, we get a new lower low. Okay, so this is how we know the market is still bearish, and we get a new lower high. Now, this is where the market shifts. Okay, when we break above a lower high, the market shifts bullish. Let me write that down. When price shifts above a lower high, the market shifts bullish, and vice versa. Now, if it shifts lower, we're just creating a new lower low and a new lower high. New lower low, new lower high. And if it keeps breaking these previous bearish elbows here, elbow, elbow, and if we came back down here, price instead of going up here, came down here, we'd have a new lower low down here and a new lower high. And since price has shifted above this lower high here, this up here, let me just do like this right here. This right here turns into your higher high up here, and this elbow here shifts into a higher low. So now we are bullish. So we've got our higher low here, higher high here. If it shifts above again, we have a new higher high and a new higher low. Okay? Now look what happened here. We shifted back bearish. So what would happen? Well, this would become a lower low, and this would turn into a lower high. Okay, now since the market's bearish, what happened next? We shifted back bullish. So now we are above this previous elbow here. So now what happens? This lower high turns into your higher high. And this turns into your higher low. Okay? So we are waiting for price to either break above the higher high or below the higher low. If it breaks below the higher low, the market then shifts bearish. If the market shifts above the higher high, we get a new higher high and a new higher low. Does that make sense? So the market is bullish, but let's keep going. So we had some consolidation here, definitely shifted bearish here. So we created a new lower low or a lower high. And then down here is our lower low. So what we would need now for the market to shift bullish again is it would have to shift above the lower high. And if we want a new lower high and a new lower low, the market would need to shift below this lower low. So until it shifts below this elbow or this elbow, it's just market structure. It's just the price. It's just the market doing its thing. Okay, so we are staying bearish until this lower high is broken above. The candlestick has to close. Okay, you see these big wicks, 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 see, look, it came up, it did not close, so price was not strong. This is where price was. This is the strength of the price here. So we did not shift bullish because the candlestick did not close above this lower high here. So we are bearish. I'm also going to put here when, kind of the opposite, when price shifts below a higher low, the market shifts bearish. Okay? And it'll take some getting used to. What I pretty much did is I picked some random pair to, and I just stared at the screen for probably 2 hours until I was identifying every higher low, every higher high, every lower low, and I just practiced until I could just look at the chart and then I could just tell it was bearish, or look at the chart and tell if it's bullish. So our weekly time frame is bearish. Now, if we're going to sell the market, we want our other two time frames to also be in sync. For our highest probability setup, we want our daily and our 4 hour and our weekly to all three be bearish. If they're all three bearish, that is a very good indication that we are going down. So we want to sell. So now I want to dive into support and resistance, or areas of interest. They're both the same exact thing. I personally like to just say my areas of interest, because that's where price has been interested in the past. So the past repeats itself. History repeats itself. I'm sure you've heard of that before. History repeats itself in the market as well. So I drew out an area of interest right here. This is a weekly area of interest. So our weekly areas of interest are stronger than our daily and our 4 hour areas of interest. The second strongest area of interest are your dailies. So you want to create areas of interest either in the weekly or the daily time frame, since they are your strongest and they will be respected. Price will respect these areas more than they will your lower time frames. So we've already identified this market as bearish, right? So what do we want to do? We want to sell. What consists of an area of interest are 3 or more touches to a certain area. So let me get this, my little circle here. We've got one touch here. Ooh. Clone it. We've got 2 touches here. 3 touches here. Touched a few times. So lots and lots of rejection from this area. And we reject it here. And, oh, and here. So we have 1, 2, 3, 4, 5 touches to this area of interest, and we're in the weekly. So 9 times out of 10, we are going to see resistance from this area. Okay, we see resistance when price is up and rejects. We see support when price bounces. So look, we've got support here, boom, area of support. That's why they're called areas of support and resistance, because the price either is supported by these areas or they are resisting these areas. When we are selling, we are wanting the area of interest to resist price. When we are buying, we want the price to bounce off or be used as support. We want the area of interest to be used as support. So in this instance, we are selling the market, so we want this area to be used as a resistance. And as you can see, it's been used as resistance 1, 2, 3, 4, 5 times in the past? Well, 4 times in the past, and this is what we're looking at now. And as you can see, it's clearly rejecting this area of interest. I'm going to put up here under support and resistance, we're going to put multiple touches equal stronger area of interest. We want, so we need an area of interest in the weekly and or daily time frame, because they are the strongest time frames and price respects them more. So I know it's kind of a lot, but if you can master market structure and then looking at areas of interest and identifying those, so now we know we are selling the market. We also know where we are selling the market. So our probability of entering this trade and making money and profiting off this trade has grown exponentially. This is our edge over the market. So if I were drawing this area of interest for the first time, it would look a little something like this. I just get my little box right here, bring it over, and I only use the bodies of the candles. I don't use the wicks because the wicks are not confirmation. When the body candle closes, that's confirmation what price is. So there's one area of interest there. I don't even know what that's for. And then I see another one down here. We've got this definitely rejected it, but we've got 1, 2, 3. I would count this as all together. But you've got 1 elbow, 2 elbow, 3 elbows in this area of interest. Now, I don't typically like making my areas of interest any bigger than 50 to 60 pips. Our market movements, small market movements, and you can test your pips by going here to this little ruler right here and going right here. So this is 32.9 pips. So pretty good stop loss. I like them narrow. Just gives me more of a sniper way of looking at the market. Okay, this is where I want to enter. This area of interest looks good. Let's see this one up here. We've also got about, so this one's like 32.9. So they're right about the same. So yeah, we've got support down here. Support on where if we're above this support area, we want to be buying. If price is down here and we're above the support area and we're bullish, so we would want to buy down here. We want to buy at our lows and sell at our highs. Pretty simple. Now that we have identified our area of interest, our trend, now we're going to look at patterns. So I want to show you guys some of the most popular chart patterns that you see. We've got our head and shoulders, our double top, our double bottom, and our inverted head and shoulders. I know you don't see inverted head and shoulders on here, but we've got our head and shoulders here, double top here, double bottom. I've never even seen cup and handle before. I don't know. I don't use it. I basically look for these top 4 head and shoulders, inverted head and shoulders, double top, and double bottom. I love when I see a head and shoulder pattern. Absolutely love it. A head and shoulders pattern is a reversal pattern. So you can profit and capitalize on this tremendously. And the probability of this playing out is very high. So the patterns you guys want to look for are head and shoulders, inverted head and shoulders, double bottom, and double top. Honestly, y'all, these are the patterns that I use. There is over 100 different patterns in the market. But when I see these four, I'm locked in. I'm going to be watching the market 100%. Let me see if I can find let me see if I can find a head and shoulders pattern in the market here. Let me go down to the 4-hour time frame. Boom, perfect. It's actually a really good example of a head and shoulders pattern. So, a head and shoulders pattern, let's see if I can find this. Yes, head and shoulders here. We've got our left shoulder, we've got the head, and we've got the right shoulder here. This is our head and shoulders. As you can see, it worked out to perfection here. I would have loved to have called this. I would have done short position right here, this neckline, put my stops above this previous elbow, and at minimum call this right here. 1 to 2 risk to reward. Perfect. That is a perfect head and shoulders setup right here. So as you can see, let me delete this. Let me get the little arrow out. So price came up, came above, broke above this lower high. This was the lower low. We were bearish, broke above. This became right here our higher low, and this became our higher high. So we're bullish, our low, new higher high. We actually broke below that previous structure point right here. Now shifting this market here bearish. So we've got a lower low and lower high, and then boom, we had the move. And all of this is just bearish, bearish, bearish until we finally broke above right here. Then we started shifting bullish again. But as you can see, this is what the head and shoulders will do. So we are catching this move all the way down here. So this right here, we'll put this line above right here. This is considered the neckline of the head and shoulders. Neckline of head and shoulders. What happened? Price rejected it. You could have gotten in here, and probably on the lower time frames, we got our entry signal right here. As you can see, price came up to the neckline of the head and shoulders, had a retest. So we call it a retest or a pullback. You can get in on the pullback, or you can wait for your entry signal whenever price does pull back. So this is what I would have done. I would have probably created like a 4-hour area of interest just to give myself some confidence. Boom, right there. Perfect. Let me just darken that so see it. So yeah, we got our one tap, 2 tap, 3 tap. So we broke this area. We retested this area. And then we got in the trade here. Set a good appropriate stop loss. targeted the lows, which would give us a 1 to 2 risk to reward. And at that point, it's your decision if you want to continue to hold, because just like right here, price came back up. It could have happened here, but price continued to go down. If you had continued to hold, you would have made a 1 to 4 risk to reward, meaning whatever you were risking, you just quadrupled it. So the market has these patterns that we can learn how they work and how to profit on them. And the same thing goes for an inverted head and shoulders. It's honestly just this, but upside down. A head and shoulders pattern is shifting the market from bullish to bearish. An inverted head and shoulders is shifting the market from bearish to bullish. So as you can see, we shifted structure, we were bearish, retested, and could have caught this huge move of a 1 to 4. That would have been awesome. But I honestly, I just like having my 1 to 2s. But sometimes you just feel like you want to hold, and all the better to you. The head and shoulders is personally my favorite pattern. That's what I look for. A double top. Let's see if we can find a double top pattern. It's really ugly. Okay, so right here we have a double top. It's not pretty, but let's take a look at it. So all a double top is kind of looks like just two shoulders instead of the head and shoulders where you have three and one in the middle is bigger. You've got two that are roughly the same size. And as you can see, price came up, rejected this area here, and then had to move to the downside, which you could have also caught and profited. An absolute avalanche here. Get our short position, could have entered somewhere around this area. Set our appropriate stop losses above the wicks, and then could have caught a 1 to 2 down here, or you could have kept holding and caught a 1 to 3 and made 3 times what you were risking. So this is not a head and shoulders, but a double top pattern. You also have double bottom patterns, and all it is this upside down. And this is also a reversal pattern. So this is shifting the market from bullish to bearish. And your double bottom patterns are shifting the market from bearish to bullish. So that's pretty much it, you guys. We're going to go over some more patterns in some lessons down the road. The patterns we're going to go over are entry signal patterns. And don't get overwhelmed. There's not many of them. Just like there's hundreds of patterns, but I only use 4 of them, and I profit so much on these 4. Head and shoulders, I profit a ton. Head and shoulders, inverted head and shoulders, double top, double bottom. And it helps to know a bunch of patterns. And I know a bunch of patterns, but I just don't use them. So I have found myself to be very profitable using these patterns because the probability when you see one of these patterns show up is very, very high, especially when it shows up at an area of interest. If you see a head and shoulders pattern at an area of interest, just like we did here, we're at an area of interest. This was a weekly area of interest, so super, super strong. Oh, I would have taken this over and over again. I wish every trade was this right here. This head and shoulders at a weekly area of interest. We are bearish in the larger time frames. We know that we're selling. We had a retest of this area of interest, and we could have gotten in up. Excuse me. We could have gotten in up here and just profited so much if we had continued to hold. So if you guys want to go ahead and screenshot this. This is my favorite pattern. This is a perfect trade setup. Let's take a look at the lower time frame. Look at our 1 hour here, lower time frame, and see how it looks. Because we enter our trades off of the 30-minute, the 1 hour, whichever one is the cleanest. But yes, so I mean, this is a perfect trade setup right here. A plus for sure. We know that in our higher time frames, we are bearish. We've got our left shoulder, our head, our right shoulder. We broke this area here, now shifting the entire market bearish. We retested, and now we just catch the sells and watch the profits just grow. So if you want to, you guys can take a screenshot of this right here. This is a perfect trade setup. If you see one of these, wait for that break of the neckline. Remember the neckline. Wait for the retest and the pullback. You could either enter off of this bearish engulfing candlestick here after it closes, or take a little riskier entry. Just know that it's risky and get in on just the pullback. So when this candlestick here closes. So that is pretty much it for today's lesson. We've gone over a few different patterns, the most important patterns and the patterns that I personally use and have profited from. And I know that you guys can do the same thing. Honestly, just go through the charts, look for areas of interest, look where price has been in the past, mark them up, and then go over your market structure, your lower lows, your lower highs, your higher highs, and your higher lows. Figure, and you practice is going to make perfect. I can sit here and I can teach you guys, but when you guys are out there grinding at this, putting in the time, putting in the chart time to find out, okay, this market's bearish, this market's bullish. Here's a head and shoulders pattern. Here's an inverted head and shoulders pattern. Where could we have entered? It's all going through and seeing what's happened in the past, and you learn from the past. So I'll give you guys just a second to kind of screenshot this. Let me go up here. I'd like to get it in the same frame. Just don't want the words to be too small. Is that too small? I think you could probably read that. Head and shoulders. Boom, perfect. Okay. So if you guys want to screenshot that, you guys can go back and read these notes. But I do encourage you guys to just spend an hour a day just looking at the charts. It can be after work or whatever. Just go look, find these different patterns, and familiarize yourself with the markets. Once you master the higher highs and the higher lows, lower highs and lower lows, then I mean now you know the trend. Now you know where you're trading. Now you know if we're going up or down. End of lesson 2. We're going to dive into market structure in lesson 3 so that you guys can really get this registered into your heads and so that you are ahead of 90% of all the other traders out there so that we can sharpen your edge of the markets and so that we can learn to trade with the trend correctly. So I will see you guys in lesson 3. See ya.